You've been told that Wall Street is finally embracing Bitcoin. You've seen the headlines, you've watched the price action, and you've heard the CEOs of the world's largest financial institutions, the same ones who once called Bitcoin a fraud, now singing its praises on financial television. They tell you it's about democratization. They tell you it's about giving you, the average investor, safe and easy access to the digital gold of the 21st century. But what if I told you that's not the whole story? What if that's not even half the story? What if the launch of Bitcoin ETFs and the flood of institutional money wasn't about giving you access, but about executing one of the most audacious financial takeovers in modern history, happening right under our noses? What if the mainstream adoption narrative is just a carefully crafted smokescreen for a silent consolidation of power? This isn't a story about Wall Street joining the Bitcoin party. This is the story of how they plan to own the entire venue. Let's start with the official story, the one you've heard on every major news network. It goes something like this. After years of client requests, major asset managers like BlackRock, Fidelity, and others finally convinced the Securities and Exchange Commission, the SEC, to approve spot Bitcoin exchange traded funds, or ETFs. The approval in January 2024 was hailed as a landmark victory for retail investors. Finally, anyone with a brokerage account could get exposure to Bitcoin's price without the perceived hassle of managing private keys or setting up a crypto wallet. It was pitched as the ultimate bridge between traditional finance and the new digital world. The financial titans were simply acting as responsible stewards, providing a regulated, insured, and convenient on-ramp for the masses. They were just meeting demand. It's a clean, simple, and comforting narrative, and it is profoundly misleading. The reality is far more complex and, frankly, far more cynical. Wall Street doesn't pivot on a dime out of public service. The same institutions that spent a decade dismissing Bitcoin as a tool for criminals, as rat poison squared, or a worthless delusion didn't suddenly have a change of heart. They had a change in strategy. They realized they couldn't kill Bitcoin. So they decided to co-opt it, to tame it, to financialize it until it was just another asset in their multi-trillion-dollar portfolio, an asset they could control. This wasn't a response to a few client phone calls. This was the culmination of a years long, multi billion dollar campaign of lobbying and infrastructure building. They didn't join the revolution, they launched a counterinsurgency. They saw a decentralized network with a market cap destined for the trillions. And instead of an existential threat, they saw the biggest business opportunity of a generation. The true story isn't about access, it's about control. It's not about democratization. It's about re-centralization. To understand how they're pulling this off, we need to look past the marketing and follow the evidence. We need to examine the weapons they are using in this silent takeover. And the first and most powerful weapon is the one they disguised as a gift, the spot Bitcoin ETF. To the average person, an ETF is just a stock you can buy that tracks an asset. You buy a share of a gold ETF, you get exposure to the price of gold. You buy a share of a Bitcoin ETF, you get exposure to the price of Bitcoin. Simple, right? But what's happening under the hood is where the takeover strategy truly reveals itself. When you buy a share of a spot Bitcoin ETF, you are not buying Bitcoin. Let me repeat that because it is the single most important concept to understand. You are not buying Bitcoin. You are buying a share of a fund, a security that claims to be backed by Bitcoin. The actual Bitcoin is purchased and held by the ETF issuer, firms like BlackRock, and stored with a custodian, overwhelmingly a company like Coinbase. You get an IOU, they get the Bitcoin. This seemingly small distinction is everything. The core principle of Bitcoin, the mantra that has defined its existence, is not your keys, not your coins. It means that if you don't personally control the cryptographic keys to your Bitcoin, you don't truly own it. You're trusting a third party to hold it for you. With the ETFs, Wall Street has, by design, become the largest and most trusted third party in the world. And the scale of this operation is staggering. Since their launch, the US listed spot Bitcoin ETFs have become the most successful ETF launch in financial history. As of late 2025, the total assets under management for US spot Bitcoin ETFs have surged to over $150 billion. At the heart of this financial vortex is one entity: BlackRock, the world's largest asset manager with over $13 trillion under its control, didn't just launch an ETF, it launched a behemoth. Their iShares Bitcoin Trust, ticker IBIT, has single-handedly dominated the market. Within its first 2 years, IBIT has amassed nearly $90 billion in assets under management, a pace of growth that has shattered every record in the history of finance. At times, IBIT alone has accounted for the vast majority of all net inflows into Bitcoin ETFs, holding over 800,000 BTC in its treasury. Think about what this means. These ETFs are acting as giant vacuum cleaners, sucking up the available Bitcoin supply from the open market. On many days, the demand from these ETFs has outstripped the amount of new Bitcoin being created by miners by a factor of 10 or more. This creates an enormous supply shock. When demand explodes and supply is algorithmically capped at 21 million coins, the price has nowhere to go but up. This, of course, attracts more investors to the ETFs, which creates more demand, which requires the ETFs to buy even more Bitcoin in a powerful, self reinforcing cycle. This is the genius of the Trojan horse strategy. On the surface, it looks like Wall Street is helping drive up the price, benefiting all holders. But what they are actually doing is concentrating the ownership of the underlying asset into the hands of a few extraordinarily powerful custodians. They are quietly becoming the new Bitcoin whales. Spot ETFs now collectively hold nearly 7% of the total mined supply of Bitcoin, a figure that has grown exponentially and shows no signs of slowing down. By encouraging millions of investors to trade a paper proxy for Bitcoin, they are accomplishing two critical goals. First, they are conditioning the market to accept a custodial model, moving the center of gravity away from self sovereignty and towards reliance on traditional financial intermediaries. Second, they are accumulating a large enough pool of the underlying asset that they can begin to exert real influence over the future of the network itself. When a handful of US based, highly regulated financial institutions hold a significant percentage of the total Bitcoin supply, they gain a powerful voice in matters of network upgrades, governance, and the overall direction of the ecosystem. The decentralized revolution is slowly being brought back under centralized control. The gift of easy access came with a hidden price tag: your sovereignty. The ETF Trojan horse was just the first wave of the attack. It was designed to absorb the physical supply. The second wave is far more subtle and potentially more powerful. It's the construction of a massive parallel financial universe on top of Bitcoin, the derivatives market. While the ETFs control the asset, the derivatives market allows Wall Street to control the price. Derivatives are financial contracts, like options and futures, whose value is derived from an underlying asset, in this case, Bitcoin. They allow institutions to speculate on, hedge against, and influence Bitcoin's price movements, often without ever having to touch a single actual Bitcoin. This is a game Wall Street has perfected over decades in other markets, most notably gold and silver. In the precious metals markets, a common criticism is that the volume of paper gold traded through derivatives dwarfs the amount of physical gold that actually exists. This massive paper market can be used to exert downward pressure on the price of the physical asset as large players can create artificial supply in the futures market. The concern among many longtime Bitcoiners is that Wall Street is now building the exact same machinery for Bitcoin. They are creating a world where the price of Bitcoin isn't discovered on the transparent, global 24/7 spot market, but is instead dictated by the moves of a few large players on the Chicago Mercantile Exchange, CME, and in the options markets tied to their own ETFs, T. And the evidence shows this is happening at a breathtaking pace. The options market for BlackRock's IBIT saw explosive growth, rapidly becoming one of the most actively traded new listings. The volume of trading in these Bitcoin-related derivatives has exploded, with the CME Group reporting that its crypto futures and options volume surpassed $900 billion in a single quarter in 2025. This is what financialization looks like. An asset born out of a desire for simplicity and transparency is being wrapped in layers of complexity, leverage, and opacity, the native language of Wall Street. It's a transition from a straightforward system of digital ownership to a complex web of financial instruments that only sophisticated institutional players can truly navigate and exploit. But the takeover isn't just about trading instruments, it's also about owning the plumbing. In finance, he who controls the pipes controls the flow of money. Quietly behind the scenes, the largest custodians in traditional finance are moving in. Giants like BNY Mellon and State Street have announced plans to offer crypto custody services, directly challenging the crypto native firms that have dominated the space until now. This was made possible by shifts in the regulatory landscape, making it more practical for traditional banks to hold digital assets for their clients. This is the groundwork for total integration. When the same banks that custody trillions in stocks and bonds also custody the world's Bitcoin, the line between the old financial system and the new one disappears. Bitcoin simply becomes another line item on a Goldman Sachs or JP Morgan terminal. Even more telling is the tokenization strategy. led once again by BlackRock. The firm launched its Bridal Fund, a product that represents shares in a U.S. Treasury money market fund as tokens on a blockchain. The fund quickly grew to over $1 billion. Why is this important? Because it shows the endgame. Wall Street doesn't just want to enter the crypto world, it wants to rebuild the entire traditional financial world on blockchain rails that it controls. They see a future where stocks, bonds, real estate, and all other assets are tokenized. By building this infrastructure now, using products like BUIDL, they are positioning themselves to be the central architects of this new tokenized economy. They want to own the Bitcoin on-ramp, the ETFs, the price discovery mechanism, the derivatives, and the very rails upon which all future digital assets will travel, the tokenization platforms. It's a vertically integrated strategy for total market dominance. Wall Street's influence doesn't stop at the market, it extends into the boardrooms of corporate America and the halls of Washington, D.C. The third front in this takeover is corporate and political capture, ensuring the entire ecosystem, from regulations to corporate strategy, is molded to their advantage. The blueprint for corporate adoption was written by one company, MicroStrategy. Under its visionary and relentless leader, Michael Saylor, MicroStrategy transformed itself from a business intelligence software company into a de facto Bitcoin development corporation. It was the first major public company to put Bitcoin on its balance sheet as a primary treasury reserve asset, arguing it was a superior hedge against inflation and currency debasement. Over several years, MicroStrategy has pursued this strategy with unmatched aggression, accumulating a war chest of over 640,000 Bitcoin. For a time, they were a lone wolf, but their success created a playbook. Now, Wall Street is taking that playbook and syndicating it to the entire Fortune 500. With the advent of regulated ETFs, the pitch is simple. An investment banker from a major firm can walk into the office of any corporate treasurer and say, "You see the currency debasement, you need a better reserve asset. Look at MicroStrategy's success. We can help you do the same, and you don't even need to worry about the complexity of custody. Just buy our ETF." They have turned a revolutionary corporate finance strategy into a packaged product they can sell, earning fees on every transaction. They are facilitating the transfer of corporate treasuries into Bitcoin, but once again, into their custodied version of Bitcoin. This corporate push is happening in parallel with a significant shift in the political landscape. For years, Bitcoin faced a hostile or, at best, uncertain regulatory environment in the United States. That has changed dramatically. The turning point was the approval of the spot Bitcoin ETFs in January 2024. But this was not a sudden change of heart by regulators. It was the result of immense, sustained pressure from the most powerful players in finance. BlackRock, a company with deep ties in Washington, led the charge. Their application for an ETF was seen as the one that finally broke the dam. Following the approvals, the political tone has shifted to be markedly more crypto-friendly. We see bipartisan groups of senators meeting with crypto executives to discuss a comprehensive regulatory framework. We see calls from government bodies to find ways to integrate digital assets into the traditional financial system. New rules for crypto taxation are being implemented, further legitimizing the asset class for institutional accounting. While this regulatory clarity is presented as a public good, you have to ask, who is writing the rules? The guest list for these high-level meetings isn't a collection of cypherpunks and decentralized developers. It's the CEOs of the largest exchanges and financial firms. The regulations being crafted are unsurprisingly favorable to large, centralized, and regulated entities, the very firms orchestrating the takeover. They are building a regulatory moat around their new empire, making it harder for decentralized competitors to operate while paving a smooth, clear path for their own institutional products. Not everyone is on board, of course. Some lawmakers have raised serious alarms, particularly about the push to include hypervolatile assets like Bitcoin in retirement plans, citing the enormous risks to savers. They point out that these assets have no cash flows and derive their value primarily from sentiment, making them a dangerous gamble for the average person's nest egg. But this resistance is struggling against the sheer weight and influence of the institutional lobby. The strategy is clear. Use their immense lobbying power to shape the laws. Use those laws to legitimize their products, and use their products to onboard the rest of corporate America. It's a trifecta of influence designed to cement their control over the entire ecosystem. So, why is this happening now? Why, after a decade of ridicule, has Wall Street decided to embrace Bitcoin with such ferocious intensity? The motive isn't a mystery. It's a convergence of existential need and unprecedented opportunity. First and foremost is the undeniable decay of the traditional financial system. We are living in an era of unprecedented monetary expansion. Central banks around the world have printed trillions of dollars, devaluing their currencies in a desperate attempt to prop up a debt laden global economy. For the world's largest asset managers who are tasked with preserving and growing wealth on a scale of trillions, this presents an existential crisis. Where do you park that much capital when cash is trash and bonds are offering negative real yields? For years, gold was the traditional answer. It was the ultimate hedge against currency debasement. But gold is an analog asset in a digital world. It's cumbersome, difficult to verify, and hard to transport. Bitcoin, with its digitally native, perfectly scarce, and globally accessible nature, presents itself as the logical successor. Wall Street didn't need to invent a new store of value for the 21st century. A pseudonymous developer already did. All they had to do was figure out how to capture it. They are now actively marketing Bitcoin as digital gold, the very narrative they once mocked, because they desperately need a new, viable, safe haven asset to sell to their clients and to use as a reserve for their own balance sheets. The second motive is control over the next financial frontier. The titans of Wall Street were late to the internet. They let a generation of tech startups in Silicon Valley build the infrastructure of the digital age. They are determined not to make the same mistake twice. They recognize that blockchain technology and digital assets represent a fundamental paradigm shift in finance. By controlling the primary on ramps through exchange traded funds, the trading mechanisms through derivatives, and the underlying plumbing through custody and tokenization platforms, they aren't just participating in the new system, they are positioning themselves to become its new central bankers. And finally, there is the simplest motive of all, profit. The opportunity is almost unimaginably large. With total global investable assets measured in the hundreds of trillions, even a small allocation to Bitcoin represents a monumental revenue stream. BlackRock's IBIT ETF, for instance, was generating hundreds of millions of dollars in annual fee revenue within its first 2 years of operation. Now multiply that across dozens of products, from ETFs to derivative contracts to custody services to corporate advisory. They are building a new financial ecosystem from the ground up, and they plan to install a toll booth at every entry, exit, and intersection. This is a business opportunity to create new markets, new products, and new fee structures that could fuel their growth for decades to come. The takeover isn't personal, it's just business. It's a rational, strategic move by the most powerful financial entities in the world to secure their future by capturing, taming, and monetizing the most significant monetary innovation of our lifetime. So, we've followed the evidence, we've seen the strategy, but the most important question remains: what does this all mean for you? What are the stakes for your wealth and your financial future? The institutional takeover of Bitcoin is a classic double-edged sword. On one side, the influx of trillions of dollars from Wall Street provides a level of validation and price support that was once unimaginable. The sheer demand from exchange traded funds acts as a powerful tailwind for Bitcoin's price. Your Bitcoin holdings, and even your traditional 401k, if it gains Bitcoin exposure, could see significant appreciation as this trend continues. It brings a sense of legitimacy and stability to an asset class once considered the Wild West of finance. But the other side of that sword is razor sharp. The very essence of Bitcoin is being fundamentally altered. The promise of a decentralized peer to peer electronic cash system, free from the control of the very banks and governments that have so often failed the public trust, is being systematically dismantled and replaced with a new but familiar custodial model. If the majority of Bitcoin ends up locked away in the vaults of a few Wall Street giants, what have we actually achieved? We will have traded a system of distributed trust for a system of concentrated power. The average person will once again be a client, not a sovereign individual. They will be granted exposure to Bitcoin's price, but not true ownership of the asset itself. They will pay management fees for the privilege of holding a financial product that is ultimately just another entry in a brokerage account subject to the same rules, restrictions, and potential failures of the traditional system Bitcoin was created to circumvent. And that's the great paradox we now face. Are we witnessing the greatest wealth transfer in history as a digitally scarce asset is repriced on a global scale? Or are we witnessing the gentrification of a revolution where the original spirit of financial freedom is paved over to build a gated community for the financial elite? The risk is that Bitcoin doesn't change Wall Street. Wall Street changes Bitcoin. It becomes just another asset for them to leverage, rehypothecate, and financialize. Another tool in a game that retail investors are rarely equipped to win. The lines are being drawn. The silent war for the soul of Bitcoin is underway. And your choice is to either become a pawn in their game, a passenger on their train, paying their fees and subject to their control, or to understand the game they are playing and position yourself accordingly. The stakes aren't just about the price of an asset, they are about the future of financial sovereignty itself. Navigating this new world, where the old guards of finance are rewriting the rules of a revolutionary technology, requires more than just holding an asset. It requires knowledge. It requires staying ahead of the narrative and understanding the forces moving behind the scenes. If you want to continue to uncover the truth behind the headlines and learn how to protect and grow your wealth in this new era, make sure you subscribe and turn on notifications. We are dedicated to providing the insights you won't get from the mainstream financial media. So, where does this leave us? The Bitcoin takeover is not a conspiracy theory. It's a well documented, observable strategy unfolding in plain sight. It's happening through the Trojan horse of exchange traded funds, which concentrate physical supply. It's happening through the sophisticated machinery of the derivatives market, which can influence price. And it's happening through the capture of corporate and political structures, which solidifies control. Wall Street didn't just knock on Bitcoin's door, they kicked it down and are now redecorating the house in their own image. The question is no longer if institutional players will dominate the Bitcoin market, they already do. The real question is what happens to the rest of us when they're finished. The next few years will be critical. They will determine whether Bitcoin fulfills its original promise as a tool of financial liberation for the many, or whether it becomes just another jewel in Wall Street's crown, controlled by the few. One thing is certain, the silent war for the future of money has officially begun, and it's a war that will define the landscape of wealth and power for generations to come.